Hello everyone and welcome back to today's daily analysis. Today is Wednesday, 24th April 2024. Let's get started. Starting with the dollar index, which traded softly around 105.7 on Tuesday. The Federal Reserve have been consistently indicating a more aggressive stance, which might prevent the dollar from dropping much as markets postpone any easing measures. The index began in the week in a narrow range and is currently below 106. The dollar strength is fueled by a robust domestic economy and ongoing inflation, leading to a more hawkish Fed stance. Despite a calm start, the dollar remains resilient, possibly testing previous highs near 106.51. The US economy shows steady growth with rising yields, helping to steady the dollar. Some Fed officials are considering raising interest rates due to stagnant inflation. For now, the markets are holding off on easing measures. For technical analysis, although the bullish momentum has slowed down, the US dollar index remains well supported above its short-term moving averages, indicating ongoing bullish sentiment. The 14-day RSIs suggest potential for further bullishness. Currently, there's a lack of clear trend, suggesting a tug-of-war between buyers and sellers, but the underlying bullish potential persists. The MACD shows the limited buying momentum. The previous highs at 106.51 and 106.8 are key levels to watch, with the break below 106 leading to potential declines towards 105.74 and 105.75. Further downside may test the 105 mark. And then on Tuesday, the US WTI crude oil was trading at around $83. It rose during the day as worries about the larger conflict in the Middle East eased. Iran's foreign minister stated that they won't retaliate against Israel attacks, while the Israel hasn't responded much. Although the WTI prices dropped to recent lows, the tensions between Israel and Iran could prevent further declines. US crude oil inventories have been rising more than expected lately, pushing WTI prices down. Also, the Fed hawkish remarks strengthened the dollar, which made the oil prices face challenges. However, hope for the Chinese demand might help WTI prices since China is the world's biggest oil importer. The geopolitical tensions are causing crude oil prices to fluctuate, but they've recently fallen to around $80.59. The support levels at 80.59 and 80 are important for oil. It's struggling to surpass the 50% Fibonacci retracement level at 83.38 in the short term. Despite falling for most of the past 12 sessions, WTI remains above its 200-day moving average near 79.61. If it continues to drop, it could test the 79.25 level first, then 77.41. On the upside, 83.38 and 84 are key levels to watch. The gold initially dropped on Tuesday, but recovered to around $2,320, almost erasing its losses for the day. This rebound was supported by the 10-year Treasury yield staying below 4.6% due to weak U.S. Purchasing Manager Index. Despite starting low in Asian trading in $2,295, the gold prices rose as investor concerns eased, leading them to a fair, higher yielding assets. As the tensions in the Middle East eased, Asian, European, and American stock market all saw gains. The gold prices then experienced a sharp decline, losing over 3.5% and erasing gains from the previous week, possibly due to a profit taking and a slightly stronger US dollar. Last Friday, the gold had reached $2,392 amid rising tensions between Israel and Iran. Additionally, expectations of a delayed interest rate cut by the Federal Reserve further dampened the gold prices. Despite Israel's retaliatory drone strike on April 19, the Tehran downplayed it as an escalation of the conflict. The gold prices dropped below 2,300, a significant psychological level for the market. If the gold failed to rise back above to April 22 low of 2,324.5 and stays below 2,300, it could signal a further decline. In such a scenario, the next potential support levels are at 2,255.2 and 2,022.3. On the other hand, if the gold manages to break above 2,322.5 The 9-day SMA high at 2,260.8, it could move towards 2004. The AUD/USD has been gaining strength, nearing the important 0.65 level, driven by increased risk appetite and weakness in the US dollar. The week started positively for AUD/USD as the risk appetite improved, with Wall Street closing higher and US Treasury yields dipping. Despite trading below 0.645 earlier in the week, AUD/USD bounced back from the yearly lows. Manufacturing activity in Australia showed improvement in April, with the Judo Bank manufacturing PMI slightly expanding. However, the services PMI, although growing at its fastest pace in 2 years, fell slightly. Economic events in the US this week, especially the release of the Personal Consumption Expenditures Price Index for March, the Fed preferred inflation measure, will likely influence the direction of AUD/USD. The AUD/USD is expected to keep falling as it stays below the key 20-day moving average around 0.6503 and the psychological level of 0.6500. If sellers remain dominant and the pair drops below 0.64 and the 2024 low of 0.6362, it could test the 2023 low of 0.627. On the upside, immediate resistance lies at 0.65 to 0.6503, followed by 0.653 and 0.6553. GBP/USD gained bullish momentum yesterday, reaching 1.245 later in the day. The dollar faced selling pressure due to weaker than expected PMI data, boosting the pair's rebound. Overnight, the GBP/USD bounced back from 1.23, the lowest level since November 14th, to around 1.235, trading in a narrow range during the Asian session on Tuesday. Currently, the prices hover around 1.235, influenced by USD price movements. Diminished concerns about a wider conflict in the Middle East support a positive risk tone, weakening safe haven currencies and offering some support for GBP/USD. However, expectations of the Federal Reserve maintaining high interest rates amidst inflation and speculation about aggressive policy easing from the Bank of England constrained the pair's upward movement. The GBP/USD recently broke below key support levels at 1.25 and 1.24, signaling a bearish trend. The 14-day RSI suggests oversold conditions. Despite this, the pair is vulnerable to further declines from its peak in March. Any upward movement is likely to face strong resistance near 1.25, with the potential for a short covering rally towards 1.247 and 1.2481. However, gains may be limited near the psychological 1.25 mark. On the downside, the recent low around 1.23 acts as the support. Further selling could push GBP/USD towards 1.2263 and eventually to 1.22. For Japan yen USD, it climbed to a new 34-year high as enthusiasm for the US dollar remains strong. Factors like robust US economic performance and significant Treasury debt issuance are driving demand for the dollar. Despite warnings from the Bank of Japan, the USD Japan yen continued to rise. The yen gained slightly during the Asian session on Tuesday, recovering from recent losses. There's speculation that Japanese authorities may intervene in the market, providing some support for the yen. The Bank of Japan has indicated it won't rush to change its policy, while the Fed Reserve is expected to delay interest rate cuts due to high inflation. Expectations for a hawkish Fed have kept US Treasury yields up, supporting the dollar and limiting downside for USD Japan yen. The traders are cautious ahead of the release of the US Personal Consumption Expenditures, the price index of a key of Japan, decision later this week. The pair 14-day RSI remains overbought, limiting new bets. If it declines further, buyers may step in around 154.3, preventing significant downside below 154. Support levels include 153.6 and 153.7. A break below 153 could trigger a sharp sell-off towards 152.5 and possibly 152. On the upside, resistance lies at Monday's 34-year high near 154.85, followed by 155.45 and 155.7. Euro USD climbed above 1.07 due to a sharp decline in the US dollar, driven by PMI data and a positive FX market sentiment. It's now testing around 1.08 amid quiet Asian markets before busy economic data releases. Both the US and Eurozone are closely watching US data, with anticipation for potential rate cuts. The rise in the US Treasury yields have affected European bond yields. The ECB signaled monetary easing in April and hinted at future rate cuts. There's a strong consensus with the ECB to cut rates by 0.25 percentage points in June, raising questions about the pace of subsequent easing measures. The euro USD climbed above 1.07 due to a sharp decline in the US dollar, driven by PMI data and a positive FX market sentiment. It's now testing around 1.08 amid quiet Asian markets before busy economic data releases. Both the US and Eurozone are closely watching US data with anticipation for potential rate cuts. The rise in US Treasury yields have affected European bond yields. The ECB signaled monetary easing in April and hinted at future rate cuts. There's a strong consensus within the ECB to cut rates by 0.25 percentage points in June, raising questions about the pace of subsequent easing measures. And that is all for today's daily analysis. Thank you for watching.